Hello students, welcome to the second part of chapter 4, that is theory of firm under perfect competition, microeconomics. As in the last part I had said that we are going to learn short run and long run firm equilibrium. In the short run, the firm output can be changed only by variable factors like labor force through overtime, and fixed factors like machinery, land, buildings, they cannot be changed in the short run, because in the short run we do not have the time to change the production or the output. So in the short run, the firm can adjust only its variable factor and not fixed factors. There is not enough time for the new firm to enter into the industry. So if the demand is increased, the supply can be increased only up to its existing production capacity. And a firm in the short run equilibrium, they may face one of these situations. They can either earn supernormal profit or normal profit, or they can suffer minimum losses, or they'll have to face shutdown point. So these are the different situations where short run equilibrium can be faced by the firm. So for the analysis of these situations, short run average cost curve, that is SAC, will be introduced. See, every firm would want that their revenue should be more than the cost. So if the firm wants to earn supernormal profit, then it is very much necessary that average revenue of the firm should be greater than short run average cost. So a firm in the equilibrium, they earn supernormal profit when AR is determined by the industry is more than its short run average cost. So we can say that firm's equilibrium point is E. We can see that point E in the diagram, which is an equilibrium point, wherein MR and AR are equal and short run marginal cost is also equal. Now, when we talk about the equilibrium output, so equilibrium output is the point EM, and since AR is greater than SAC, that is, we can see in the diagram that our EM is greater than AM. So when we, the difference between EM and AM will give us supernormal profit per unit of output. The total supernormal profit of the firm on the OM output from the diagram, we can see the shaded area, which is firm's supernormal profit. So this was a situation wherein the average revenue is greater than your short run average cost. Now talking about the second situation, that a firm may also face normal profit, wherein the average revenue is equal to your average cost. So a firm in the equilibrium earns normal profit when average revenue, that is price per unit, determined by the industry is equal to its short run average cost. And the firm's equilibrium point E, which we can see it in the diagram, where MR is equal to AR is equal to SMC. So we can say that our equilibrium output, which is point EM, at this output, AR and SSC both are equal to EM, and firm is earning normal profit per unit of output. So kindly refer to the diagram, and you can see that there is no gain in terms of money for an entrepreneur, as this profit is included in the cost of production. And that is why we can see the red line, which is profit, our SAC, which is just exactly touching the price, that is our AR and MR, which means that both are equal. So which means that the firm is earning normal profit. Talking about the third situation of the firm in the short run equilibrium It could be minimum loss. Minimum loss means wherein our revenue, firm's revenue is less and the cost is more, which means the income is less and the expenditure is more. So a firm may continue production even if it is incurring losses, because in the short run, it cannot leave the industry. And obviously in this situation of loss, a firm will be in equilibrium at level of output where it gets the minimum losses. That is when SAC is more than AR. So we can see in the diagram equilibrium point E, and at equilibrium AR is equal to EM and our SAC is equal to AM, and also from the graph we can find out that our average revenue is less than our average cost, because we can see that the white curve of SAC is much above, which shows that the cost is more. So firm's per unit loss is nothing but AM minus EM, and total loss at OM level of output is equal to OM into AE. That is, we can see that the shaded area, which is EABP, that is the loss, which is above the price level where we are not able to cover up the cost. So even if the firm discontinues the production, it will have to bear the loss of fixed cost, which is minimum possible loss of a firm. Now, when we talk about shutdown point, this is a situation wherein the firm is not at all earning profit and they are facing the situation where they'll have to shut down the company, which absolutely shows that average revenue is less than your SAC, that is short run average cost. And the firm will shut down if it cannot cover the average variable cost even. A firm should continue to produce as long as price is greater than your average variable cost. So once the price falls below that point, it makes sense for the firm to shut down the company or the firm temporarily and save all the variable cost. So if price rises to OP1, let's say for example, we can see it in the diagram that if the prices rise from OP to OP1, then the firm can cover some of its fixed cost also. So the minimum point of short run average variable cost is called firm's shutdown point. And the shutdown point is the point at which the firm will gain more by shutting down than it will by staying in the business. We can see the point E when it falls below, and the shaded area where the company is earning huge losses. Now let's talk about long run. We saw all the situations of short run equilibrium, that is firm's equilibrium, and the second one is long run firm's equilibrium. As I said that in the long run, the firm's output or supply can be changed by both variable factor as well as fixed factor, which means that all the factors of production becomes variable and there is enough time for the new firm to enter into the industry or market. So if the demand is increased, the supply can also be increased or decreased according to the demand. So in the long run, a firm can make all sorts of changes which they desire to, which means they can make changes in labor also, they can make changes in the fixed capital also. And for the long run equilibrium, long run marginal cost is equal to MR, and long run marginal cost curve cuts MR curve from below. So in case of long run equilibrium, all the firms will earn only normal profit. Even if there are no situation of short run, they will sustain only fewer times. Let's take the case when the firm earns supernormal profit. Then the existing firm will increase their production and new firm will also enter the industry thinking that they would be able to earn more profit by seeing the other firms that they are earning supernormal profit, and in order to earn supernormal profit, new firm will start entering the industry and they will also start producing the goods. So consequently, the total supply will increase and price will fall. And further, that would result into normal profit for the firm. Let's take the otherwise. If the firm is incurring losses, then some of the firm may leave the industry, which will reduce the total supply. And due to decrease in supply, the prices will rise. And once again, firm will begin to earn normal profit. So the normal profit of the firm is also termed as zero economic profit, as this is included in the cost of production and not in the economic profit. We can see in the diagram itself, the firm's equilibrium is at minimum point of its long run average cost, that is LAC, and at this point, the firm will get normal profit. So let's say if average revenue or if price rises from OP1, then firm's long run marginal cost cuts its MR1 at E1 of the firm and they get supernormal profit, but again come to OP yielding normal profit as stated before. And at price OP2, firm incurs losses but again rise to the level of OP to maintain the equilibrium at normal profit. So we can say that firm's equilibrium is MC, that is marginal cost, is equal to MR is equal to AR is equal to minimum long run average cost. Thank you.